From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. A bit of softness, basically range-bound here as we count down to the open, which starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Coming up, stocks on hold, treasuries extending their declines as traders continue debating the Fed's next move. And the banking crisis comes to Capitol Hill. Let's begin with the big issue, recession fears versus rate cut hopes.
Right now, the market and Fed are playing a game of chicken.
I have heard a lot of people thinking that we are going to have rate cuts.
The market has anticipated a lot of rate cuts this year.
The market's pricing in, give or take 100 basis points, of rate cuts by the end of the year.
The bond market is somewhat, dismissing the Fed's dot plot.
Rate cuts are being priced because there's a significant risk of an economic shock.
I think recession probabilities have probably crept up.
Global economic growth is decelerating and a recession is likely to play out.
If the Fed really sees a recession coming, they're going to do something.
The bond market is sort of jumping ahead of what the Fed is saying.
When you think about the Fed and all of these, they've still got a big inflation problem.
There's a huge gap, a huge spread in the views out there.
So basically trying to put it all together and make sense of us is Clear Harbor's Aaron Kennan and Eric Nelson of Wells Fargo, who are going to tell us what to expect in a wash of absolute uncertainty. I really want to start with this one question, though, for both of you. Are rate cuts good or bad for risk assets? Aaron?
Well, that's a great question. They tend to be better for the longer duration part of the risk asset space. So, sort of the growthier components of the equity market. When you have markets trending lower due to credit tightening concerns, a banking crisis, and the potential for a pending recession, it would seem as though that sort of long duration equity rally could very well be short-lived. But it's interesting also, Lisa, to see equities trading roughly today where they were just prior to when we started hearing about Silicon Valley Bank.
Basically, and this is really, Eric, I would love to get your take on this as well. There is a feeling that we are no further away from a soft landing when it comes to stocks than we were before Silicon Valley Bank because of some of the rate cuts being baked into market expectations. Do you take issue with where markets are right now?
Well, Lisa, I think it's the biggest issue I take is how quickly the market is pricing the cuts. I think it's very hard to sit there in front of someone who's actually holding risk in this market and say, the Fed is not going to cut rates and you should not be pricing that. I think there's obviously a lot of recession fears out there. There's a ton of uncertainty over the banking sector. So even if you think the Fed won't be cutting in the next 6 or even 12 months, there's a risk that more cuts get priced in the meantime as the turmoil picks up again. But again, I think the Fed, the bar to cut will be higher in our view, and also the time sort of with which the Fed will be sort of eager to cut will also be longer than in prior cycles. So what we're seeing today is those cuts being pushed out, so back toward the back end of 2023 or even into 2024, which I think is a sensible thing to do right now. Ultimately, we do think the Fed is going to be, again, very cautious and sort of moving toward a rate cut. So those hopes for a cut, I think, will be take a very long time to actually be vindicated. And so for right now, I think the trade is to see those cuts being pushed out as opposed to being priced out.
Well, I think that a lot of people would agree with you. BlackRock's Sway Lee among them. She wrote a note for BlackRock saying that, quote, that's the old playbook when central banks would rush to the rescue as the economy, as recession hit. We see a new, more nuanced phase of curbing inflation ahead, less fighting, but still no rate cuts. Right now, the market is pricing in almost a full 1 percentage point of rate cuts by the beginning of next year. Aaron, from your vantage point, how much is this an opportunity for you to push against the market pricing and say, okay, this is illogical. We are going to see something else and capitalize on it?
Well, it's interesting. I think the Fed is sort of, there's a conundrum that they're faced with, which is, they see a lot of the headline inflationary pressures decelerating, and we all sort of applaud that. but we look at the wage picture, we look at the overall employment picture, we look at the labor participation rate, and it's not back to where it was even pre-COVID. And so I think that the Fed is very much of the view that they really want to slay this inflation dragon. And I would argue that it's even more imperative in 2023 they do it than in the early 80s, because debt to GDP at the public level was 120%. Back then, it was 35%. So every 1.5% rise in the weighted average cost of capital to our deficit adds about $450 or more billion of interest. And so in some sense, I think the Fed needs to slay inflation, which is why it's been the most dramatic, most quick tightening cycle that we've seen over the last 7 cycles since 1983. And so it's sort of interesting to see that ultimately where they want lower inflation, and they need it quickly, but they need to make sure that they fight it hard in order to get there.
Yeah, a lot of people don't believe that they're actually going to do that, I think, which is one reason why you do have this reduction in interest rates that's sort of being baked into the market. A lot of people, though, also saying that the chance of recession, yes, is getting higher, but still isn't the base case. Goldman's Jan Hatzius among them seeing perhaps a 35% chance of recession in the next 12 months. He writes, quote, reduced credit availability will prove to be a headwind that helps the Fed keep growth below potential, despite the support from rising real income and better global growth. Not a hurricane that pushes the economy into recession and forces the Fed to ease aggressively. The risks are clearly skewed toward larger negative effects. So, Eric, from your vantage point, do you think that this is accurately priced into risk assets at this point, that, yes, we may avoid recession, but it will be a slow growth kind of environment for a pretty long period of time?
Yeah, well, Lisa, you've made the important point about the optimism that the Fed will be quick to cut rates. And that's a huge assumption that the market is making right now. And that may end up proving ill-advised. So what concerns me is that you may start to see growth really deteriorate, labor market deteriorate, and the Fed be very cautious about cutting rates. So that usual interplay between recession, lower rates, risk assets may not play out exactly the same way as it has in the past. And so thinking about sort of the read-through to other assets, you look at, for example, the question of QE, I think, is also really important to keep in mind as well. Will the Fed be quick to expand its balance sheet, not from something like BTFP, but more from something like QE? If they're hesitant to do that as well, then you start to think about even steeper curves than you would typically see in a recession scenario and other sorts of dislocations relative to past cycles.
Well, let's talk about Fed speak. We're going to get more of it and economic data as well coming through the week. Let's get to Michael McKee to get a sense of what's on deck. Mike.
Well, Lisa, we're probably going to have a lot of Fed officials talking back to the folks you've been having on the show lately, saying that the Fed is going to be cutting rates, because the Fed's not going to be cutting rates, at least according to them. A lot of Fed speak this week. We've got Jefferson yesterday, didn't really address it, but Barkin, Collins, Kashkari, Williams, Waller, Cook, Barr before the end of the week. And those who are talking about monetary policy expected to say we still need to focus on inflation. The banks are one thing, but inflation is the issue, and we're going to keep rates where they are for a long time. Now, Michael Barr is not going to be talking about that. We know he's going up to Capitol Hill today to talk about the bank situation. Here's the bank situation as far as the economy and the Fed are concerned. You can see how the blue line shows that many banks have tightened credit standards already. And this is February data. We don't have the latest loan officer survey, but those in the white line who have tightened it a lot, very small. So does that number go up? And the yellow line, that's commercial and industrial loans that we have been seeing from the banks in America. And even though lending standards have tightened, you can see that lending has not. Rest of the week, we've got nothing really until Friday. Personal income, spending, and the PCE inflation numbers, those should reinforce the Fed's message. But the Fed's meeting isn't until May 3rd, so it's probably not going to matter as much as the data we get between now and then, particularly on what banks are doing with lending and whether that actually is a problem.
Michael McKee, thank you so much. And that really is a problem as well when you've got a Fed that's data dependent and then an absence of data at a time when people are so clearly trained on bank issues. Aaron Kennan and Eric Nelson are still with us. Aaron, from your vantage point, how much are you seeing the recent stresses in the financial system as a game changer, as potentially accelerating some of the slow growth that people have been talking about for a while?
Well, it's certainly helping the Fed do, some of their work. If you look at the dot plot, they were at 5.6% for year-end terminal rate 2023, and this time around, that was back in December, and now they're at 5.1%. And so it's almost as though they're pricing in, the fact that this banking crisis is tightening financial conditions without them having to do anything. And so some estimates are that conditions have tightened well over 100 basis points. And so I think it just accelerates and raises the probability of a recession. You're tightening lending standards. 70% of consumer loans occur at the regional bank level. There's a lot of uncertainty there going forward. And you look at the inverted yield curve, and yes, it's less inverted now than it was back in early March, but that tends to be the case as you're entering a recession where the curve becomes far less inverted. So I wouldn't necessarily view that as a silver lining for those who think we're going to avoid a recession.
There's also a question about what is the next shoe to drop. And Eric, from your vantage point, do you see another likely crack likely to emerge as some of the lag effects of rate hikes start to take hold?
Well, the first point I want to make, Lisa, is I'm not necessarily sure this current U.S. banking sector issue is fully resolved. We still have questions over some of the back and forth we've heard from the Treasury on deposit insurance, whether or not all deposits will be guaranteed. And there's also some hope and optimism out there that the Fed and regulators will enhance the existing liquidity tools in order to support the banking system. But that actual action is still forthcoming, and we're not sure exactly what could trigger it. So I'm not ready to put this current crisis behind us. The other point, I guess, would be in terms of what comes next. In the U.S., we've had a lot of questions about CRE and office lending, and I think that's something to certainly watch for, but probably over a longer time frame. I do worry about a couple of other things, and one in particular would be in the Eurozone, looking at the peripheral bond markets. Certainly something to watch here. But for right now, I think that the acute issue in the U.S. banking sector, to me, is not fully resolved yet where we can put it behind us.
So, Eric, what are you looking at in particular for a possible next step in this issue that has yet to be resolved?
Well, certainly Barr's comments today will be very interesting, and I do suspect he will be pressed on questions over deposit insurance and how the recent sort of issues around the banking sector have been resolved, and what that means for the playbook going forward. So I think it's certainly an important day today, and really want to getting a sense of, how is the market behaving around some of these banking, whether it's in the credit market and the equity market. That's what I'm watching most closely, as opposed to necessarily looking at the typical indicators like Fed pricing or what FX are doing.
We were talking about this last week, that perhaps the Fed is looking at bank stock as one of their data to be aware of and dependent on. Aaron Kennan and Eric Nelson, both of you are sticking with us. Coming up, day one of the Silicon Valley Bank hearing.
There's got to be an explanation as to why the San Francisco Fed overlooked all of these flashing signals. I think there's going to be very tough questioning. The credibility of the Fed is on the table today.
That conversation coming up.
I think this hearing matters a lot. There's got to be an explanation as to why the San Francisco Fed overlooked all of these flashing signals. I think there's going to be very tough questioning. The credibility of the Fed is on the table today. Obviously, Michael Barr will be a key player. But again, I would just reiterate, there were flashing red signals that the San Francisco Bank, which had a very cozy relationship with the Silicon Valley Bank, just chose to ignore.
Financial regulators back in the hot seat as lawmakers begin their investigation into SVB's collapse. First up, the Senate, and in the line of fire, Fed Vice Chair for Supervision Michael Barr, the top central bank official looking to reassure Congress on the country's, quote, sound and resilient banking system in his prepared remarks, calling SVB's collapse a, quote, textbook case of mismanagement. This coming as the Fed chair gets his own call from Capitol Hill. Senators sending a letter to Powell questioning whether the Fed has used its full powers in supervising lenders. Team coverage of this incredibly important hearing starts right now. Bloomberg's Anne-Marie Hordern alongside Kaylee Lyons down in Washington, D.C. Kaylee, I want to start with you. Right, we are looking at the hearings that are set to begin, I believe, in about 45 minutes' time. What is the tone? What is the goal of these particular proceedings?
Well, the goal of this hearing is to unpack what happened and why, and what regulation and supervision may need to change in the future to prevent something like this from happening again. These three testifying today are going to be facing some very difficult questions, particularly the Fed's Vice Chair of Supervision, Michael Barr. As you were just illustrating, a lot of question around what supervisors knew when. He does address that in his prepared testimony that was released yesterday. He said that staff were actively engaged with SVB, but ultimately the full extent of the bank's vulnerability was not apparent until the bank run actually happened. He also goes into detail around that 2018 rollback of certain Dodd-Frank requirements and says that the Fed is looking into how more stringent measures being applied to SVB may have prevented its failure. That is also a subject touched on by Marty Grunberg, the FDIC chair, who basically says that these failures show that banks with $100 billion in assets do have implications for financial stability, and as a result, prudential regulation of these institutions merits serious attention. So it's going to be a lot of conversation about how regulation and supervision need to change to prevent this in the future, but also how do you stem the bleeding right now as we are still concerned about deposit flight from smaller institutions to those deemed too big to fail, which is where the question of the FDIC insurance cap comes in. Should it be raised? To what level? Should it be lifted indefinitely? For what period of time? Those are going to be the kind of questions faced by those testifying today.
A lot of people also looking to what kind of policy response is implied by the questioning, implied by the aligning of different camps in Congress. Anne-Marie, what are you learning about what the camps actually are, what some of the politicians are hoping to get out of this?
Well, listen, what this is going to be is a hearing with a lot of questions, but also, Lisa, a lot of statements. You have some of these senators that are up for re-election next year, like Sherrod Brown, the chair, very hard re-election. Senator Elizabeth Warren, she re-announced her campaign yesterday. So they're going to take a lot of this in a partisan view. The Republicans want to point to supervision. They also want to blame the president for bailing out what they call a quote-unquote woke bank. And then you have the Democrats who are really going to want to talk about the rollback of some regulation, that Dodd-Frank regulation under the Trump administration. But remember, Lisa, there are moderate Democrats who voted for this. So there's really not a consensus yet of what potentially lawmakers can move on.
All right, Anne-Marie and Kaylee, thank you so much. We'll be catching up with you throughout the day as we do get this turmoil in the banking sector. It has kept J.P. Morgan defensive strategist Marko Kolanovic laying out his rationale, writing, quote, first, higher uncertainty should put upward pressure on risk premia embedded in asset prices and increase the need for precautionary savings among investors. Second, economic forecasts have a long way to downshift to catch up with markets. Still with us is Aaron Kennan and Eric Nelson. Aaron, what I'm struck with is, yes, on one hand, you could have constrained lending. On the other, it is clear that even smaller banks are systemically important, at least as defined by needing a bailout or needing some sort of intervention. And there seems to be an implicit support for the financial system. So where are you looking for nodes of stress that could potentially pressure equities in a more substantial way?
Well, when you essentially tighten lending standards within the banking segment that caters to small businesses and consumers, you know, you're ultimately statistically increasing the likelihood of recession. And usually there's a lag effect by about 3 or 4 quarters. So if that's sort of happening or has been happening over the last quarter or so, and particularly right now due to the banking crisis, we think by mid-year, later this year, that the risk of recession is significantly elevated. But let's not forget, too, you know, they're meeting in D.C. today, and they're talking about regulation. You know, at the end of the day, to me, there are 2 things to consider. One is the diversification of deposits and the sectors that they represent in industries. In this case, it was very tech-sensitive. But the other is traditional banking is about lending, borrowing short and lending long. And when you think about that, the only way to sort of rectify that is to not borrow, not lend as long, to sort of like turn a bank into an insurance company, to really match your duration. And if you do that, that means you're going to have significantly higher loan rates, significantly higher mortgage rates. I think that's politically untenable, too. And so that's the dilemma that will be faced by politicians. They won't say that, but that's what we should be thinking about.
You can feel it right now with the letters that they're getting from their constituents saying, don't let our banks fail, while also saying we're not going to bail them out because we don't want to be accused of bailing anyone out. Kind of stuck there between very different kinds of goals. Aaron and Eric. Eric, I'm curious from your vantage point how much you've brought forward your expectations for a recession as a result of what we've seen over the past 3 weeks.
Well, Lisa, I have to give substantial credit to our economics team, which has been calling for a recession to start around Q3 for the last 6 months or so. Maybe that we bring that forward a little bit, maybe by 2 or 3 months toward the middle of the year, but these things still take time. We still have not seen jobless claims move up hardly at all. The Challenger job cuts do point to some jobless claims in the pipeline, but it could still be a couple months before we start to see real significant turnover toward weakness in the labor market. And that's going to be a challenge for the market that is really waiting for the next immediate catalyst to trade on. Like I mentioned, the banking sector issues may not be resolved in the short term, but trading the recession could be frustrating for people waiting for something to happen imminently when really the business cycle dynamics do take quite a while, months if not quarters, to play out.
There's also a question of whether, if this doesn't take hold in terms of tensions, we end up with a bigger potential problem with inflation. Eric Nelson, thank you so much. Aaron Kennan, you are sticking with us through the opening bell. Coming up, the morning calls and later retesting the lows. Why Bowerstock's Emily Hill thinks the S&P can go as low as 3,200 in the first half. That conversation happening around the opening bell. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro. After yesterday's somewhat constructive tone to markets, we're seeing a bit of softness, but not much. The interesting thing is the S&P and the NASDAQ are down about the same amount, despite some of the underperformance of the NASDAQ yesterday, a departure from what we have seen over the past few months. In the yield space, you are seeing yields just a touch higher. The underperformance coming from the long end of the curve, the idea being potentially people are getting a little more worried about inflation over a longer term if they start thinking about rate cuts in the near term. Time now for our morning calls. Some of the analyst recommendations on Wall Street this morning. First up, Wells Fargo upgrading Carnival Cruise to equal weight, seeing minimal refinancing risk and steady business out of Europe. Next up, Cowen upgrading Occidental to outperform, highlighting the company's resilient assets. And finally, Bank of America downgrading Fox to neutral, pointing to secular headwinds and a lack of near-term catalysts. Coming up, Disney reportedly ditching its metaverse plans as job cuts get underway. That conversation up next with Bowerstock's Emily Hill. We are seeing layoffs continue in tech and entertainment as people think, what is the next one to experience some stress? From New York, this is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. Moments away from the start of trading on a day when you really see equities and bonds treading water, trying to find direction. After yesterday's firming up, particularly of the S&P, you're seeing today S&P kind of clawing back some of the losses from earlier, down about 0.1%. Same deal in the NASDAQ. And you're seeing yields slightly higher as people potentially gain out what it looks like if inflation does pick back up, if you do get a Fed that doesn't cut rates quite as much as people had expected. You're seeing a bit of dollar weakness. This has been a theme anytime that there's a sigh of relief. The euro 108.30 and crude a bit softer, $72.55. One sector to watch at the open, it continues to be the banks. In less than 30 minutes, the Senate Banking Committee kicking off the first congressional hearing into the collapse of SVB and Signature Bank. Katie Greifeld joining us now with more. Katie, what are you looking for?
Well, Lisa, thankfully, it's a little bit quiet in the banking sector as we wait for those hearings to kick off. Let's start with First Republic. Still a lot of question marks over this name. It's up slightly after a big relief rally yesterday. And part of the reason it rallied so hard yesterday was you had First Citizens buying SVB. So that surged almost 54% yesterday alone. But now you can see shares down slightly as well, as are shares of Schwab and Bank of America. And even though some of the worst case fears have quieted for now, these hearings are happening against a backdrop of deposits shifting from smaller banks to bigger banks. So here you're looking at a 4-week moving average. And in the most recent reading, large banks actually saw positive deposits. And for the foreseeable future, I would bet that that H8 deposit data on Friday is going to be a top tier release. And in any case, small banks, they're lagging in the stock market as well. You're looking at KRE here. That's in orange. That's the regional banks ETF versus XLF, which tracks the broader financial sector. And as you can see from that orange line, last 3 weeks or so have left a mark.
Thank you so much, Katie. And we are also watching Alibaba after splitting into 6 separate companies. Its shares right now in the United States surging 11% on reports of these plans. We will follow that story throughout. Layoffs, meanwhile, in corporate America picking back up. Disney kickstarting its $5.5 billion savings plan with the first round of what's expected to be a total of 7,000 job cuts. Bloomberg's Isabel Lee joining us now for more. Isabel?
Hi, Lisa. Yes, it is the beginning of a 7,000 job cuts, but this isn't really a surprise because this was first announced in February by CEO Bob Iger. So the company sent out a memo on Monday saying that this is the first wave. The second wave will be around April, and the third wave, hopefully the last, will be around summer. So Disney stocks are kind of trading flat, but for the year, it's up around 10%, and in the past 12 months, it's down around 30%. So 7,000 sounds a lot, but relative to Disney's 220,000 employees, it's really just 3.6%. And the cut comes as Hollywood tries to handle pressure from Wall Street to post profits. And Disney isn't alone. Major entertainment firms have been aggressively cutting, like Paramount Global and Comcast. Iger joined in November after leading Disney for 15 years and after his successor was fired. And his main goal was one thing, to just really improve financial performance. So this includes the uber competitive streaming business. Last year, Disney lost around $120 billion in market value, so he's really looking to change that. And since Iger becomes CEO, Disney has outperformed the S&P 500, but has still lagged the sector. But it's only the first 3 quarters of the year, so we'll see.
Isabel, thank you so much. Meanwhile, Bowersock's Emily Hill looking for a retest of the lows on the S&P, writing, quote, "We still believe the S&P will more likely than not retest June and September lows of the first half of 2023. A new low at 3,400 or even 3,200 is possible. U.S. large cap stocks are not yet undervalued. Base case is a U-shaped downturn, sort of a frown." Emily joining us now alongside Aaron Kennan, who is still with us. And Emily, from your vantage point, why has that not transpired, given a banking stress, given the belief that we see with respect to lag effects finally coming to the fore?
I think there are 2 reasons for that. The first is that there is still a huge amount of liquidity in this economy. You know, our money supply is at 21 trillion. That's about 39% above what it was pre-pandemic. And so we've got an extra 6 trillion sloshing around the system. And so that is allowing asset prices to stay inflated. You know, and the second reason is that I think the market has not accepted the fact that we have undergone something of a sea change in the last 2 years, 2+ years. Every hiking cycle that we have gone through since 1991, 1991 was the last time that inflation was over 4%. All of the previous hiking cycles in recent memory have taken place in a low inflation environment. And so I think the idea that the market is now pricing in rate cuts in the summer, that I think we've seen a huge divergence between what the market is expecting and what the Fed is ostensibly planning. So I think that is the reason. Those are the 2 primary reasons that U.S. large cap stocks remain inflated in price.
Well, Aaron, I'd love your sense on this, too, because we've seen this time and again. People try to get bearish, then they get stopped out of that, and then all of a sudden there's sort of forced buying that leads to even higher highs. How much are we going to continue to see this until something breaks more materially and more consistently?
Well, it's interesting, man. I think everyone's trying to size up where the Fed is in all this to try to predict, where rates are, where the curve is. During transitional periods in the economy, particularly in this modern day Fed where we have the SEP, the dot plots, during these transitions, the Fed has not been close to accurate. If you want to even, sort of think of this SEP as a predictive measure, which they don't like to articulate that it is. But if it isn't, then why do we have it? As we entered 2022, for example, they said year-end Fed funds would be at 1%. They were over 4%. And so, it's just not clear that we can use the Fed as indicative of where we're going. Conditions are tightening in the economy. The bond market tends to be correct by a wide margin over the course of history relative to the equity market. I'm very sensitive to that as an old bond trader, but also just looking through the historical analog. The curve's still steep. It's not positive, but even if it was positive, that tends to occur, as I mentioned earlier, as we enter a recessionary period. You look at growth stocks, they've massively outperformed value on a year-to-date basis, particularly large cap. And that seems to be indicative of the rate move that we've seen. I'm less excited about equities here. If you look at forward PE multiples, they're still well above 25 averages. If you look at equity risk premiums, they're only trading at about a 200 basis point spread. That is the earnings yield of the S&P 500 minus the 10-year Treasury yield. Usually when the dust settles and there's clarity in the market, that's closer to 300, 350 basis points. So equity risk premiums are not that attractive right now.
Just real quick, though, Aaron, do you agree with what we heard from Emily, that we could get down to 34 or 3,200 on the S&P?
Sure, it's possible. And I think that's the recession. That's what happens when we enter a recession. We see real earnings deterioration, and markets finally react to that. We're still here sitting predicting whether or not we're going to have a recession this year, or we're going to have one next year, or we're going to have one at all, hard landing, soft landing. The market right now does not appear to be pricing in a recession. And I think there's a bit of a disconnect between the rates market and that predictive number right now. And we'll see how that plays out with the forward-looking data going forward.
Aaron Kennan, thank you so much for being with us. Still with us is Emily. Turning to earnings, Walgreens and PVH beating profit estimates, both companies highlighting their confidence in delivering a strong fiscal year ahead. Katie Greifeld back with us for more. Katie, despite all of the naysayers about people not spending, that's not what's going on right here.
Not what's going on at all. And we got a nice reminder of that this morning from both Walgreens and from PVH. Both beat expectations, like you said. PVH by a lot, and you can see that in the share reaction. PVH currently up about 16% or so. And for context, PVH is the owner of Calvin Klein and Tommy Hilfiger. And apparently people are buying denim right now because revenue came in at nearly $2.5 billion. That was a beat overall. And sales beat at both Calvin Klein and Tommy Hilfiger. And overall EPS beat by quite a bit, as you can see. Moving on, though, Walgreens EPS also came in above expectations in the second quarter. And the outlook, though, is the interesting part. As you can see, EPS is expected to be significantly higher in the fiscal third and fourth quarter, and that's boosting shares slightly, currently up about 1.6% or so, Lisa.
Katie, thank you so much. What we are seeing from PVH, we were talking about that earlier, is the best day of gains right now, going back to November of 2020. Sean Darby of Jefferies expecting earnings to drop in the next 2 quarters, writing, quote, earnings are set for their biggest decline from this point, while layoffs will accelerate. U.S. real rates are at a choking point for the economy and financial markets, and high money market fund additions suggest precautionary behavior, not deflationary. Emily Hill still with us. Emily, how do we get from earnings to a reaction in stocks? In other words, will the earnings calls that we get in the next quarter possibly be the trigger that you're looking for?
Well, it's interesting. I agree with Mike Wilson of Morgan Stanley on this. And, the day of reckoning keeps getting delayed. And so I was listening to your quoting my words about the first half of 2023, and I was thinking, maybe I should delay that by a few months. But I do eventually, we are going to see the impact of all of this in earnings. It's just a question of when that's going to happen. We have to remember rates have not risen this quickly since the early 1980s. And I think that we're seeing now, as we did with, as we have just seen with this banking crisis, that there are unexpected impacts of that I don't think people really understand yet. And so it's taking a while for these rate increases to reverberate through the economy, and it will impact earnings. It's just a question of when.
Well, Emily, this is really the trick, though. A lot of people have been saying this, including, as you pointed to, Mike Wilson. And just as many people say, you're not right. We look around. We see that the economy is doing OK. We see that earnings are holding in there and stocks keep going up. How long can you stick to a call, especially if it keeps getting delayed at a time when a lot of people do expect the pain to come? We just don't know when.
Yes. Okay. Well, this is one of the fascinating things that we're seeing in this economy, and it's a puzzle. So, you know, my family was traditionally in the paper business, corrugated boxes. And so my uncle still runs a box company, you know, that's producing paper. And it's traditionally, as you probably know, a leading indicator. I call him up, which I do periodically. In his view, things are dire. You know, he thinks we're about to go into another financial crisis similar to 2008, 2009. But you go downtown in any big city, including Lawrence, Kansas, and it's packed. You can't get a parking place. You can't get a reservation in a restaurant. We really have a bifurcated economy here. And so, yes, you're right. I mean, all of these people, the bears, you know, are continuing to delay their calls. But again, we're going through a period that we haven't seen in 35 years. And so I think it takes a while for this to sink in.
What does your uncle say in terms of why he has such a negative view on what's to come? Is it just that forward-looking orders are not coming in the way that he thought, or is it just basically a feeling that he gets from the inflation and sort of how much that dampens the entrepreneurial spirit?
It's partly the latter, but there's also an enormous flood of paper. You know, paper factories are shutting down. You know, people are trying to unload it. And so that is, you know, the leading indicator, you know, someone, or I should say a leading indicator. You know, there's someone from Bloomberg that calls them every few weeks to check in and, you know, take his temperature on what's going on. So I think it's both. And, you know, this is purely anecdotal, right? This is one person in the Midwest who, you know, manufactures boxes. But I just think that, you know, we are, when you look at the manufacturing numbers, they're not great. Yet the service economy, you would think none of this was happening.
And that's been one of the hard things, yeah. It's been one of the hard parts about getting your heads around this economy, just because there is a sort of rolling recession. Emily Hill, unfortunately, we have to leave it there. Thank you so much for being with us. Coming up, corporate costs continue to be executed.
There's been a general round of cost cuts. What you're seeing is a reset of that back to some degree of reality.
That conversation coming up.
This is Bloomberg The Open. I'm Lisa Mateo, live in the principal room. Coming up, Bloomberg Technology. On Bloomberg Technology, David Risher, incoming Lyft CEO. That's 12 p.m. in New York, 9 a.m. in San Francisco. This is Bloomberg.
There's been a general round of cost cuts. If you look at a lot of the companies that have done the cost cuts, you could very easily argue that they overhired in recent years when growth was prolific and they thought growth would continue to be prolific. And so what you're seeing is a reset of that back to some degree of reality.
Corporate America continuing to roll out cost-cutting measures, with the latest coming from McKinsey, just announcing that they are cutting 1,400 jobs this week in a restructuring. Disney beginning its first wave of job cuts with the goal of eliminating 7,000 positions. CEO Bob Iger writing in a memo to staff, quote, "There will no doubt be challenges ahead as we continue building the structures and functions that will enable us to be successful moving forward." This coming amid a Wall Street Journal report of Meta's plans to lower bonus payouts for some of its employees. Bloomberg's Alex Webb and Mandeep Singh joining us now for more. Alex, I want to start with you about the restructuring at Disney. How much is this a Disney story, and how much is this a streaming story as we readjust to a new content era?
I think it's partly a streaming story. It's also partly an interest rate story. What we saw back in 2020 when Dan Loeb came in as an activist investor said, cut the dividend, double down on Disney Plus, and basically reframe yourselves as a growth stock. And Disney's price to earnings ratio went from something in the order of 25 times forward earnings all the way up to 80 times forward earnings. It went above Netflix, which around that time was trading at 50 times forward earnings. What we've seen since is, and you can see here in this chart, the blue line is Netflix, the white line is Disney. What we've seen since as we've come out of the pandemic, fewer people have time to spend watching streaming, and at the same time interest rates have come up, which means that growth stocks have suffered as a consequence. You tie all those things together and you end up with Bob Iger coming back as CEO and cutting a huge number of jobs.
Alex, just quickly here, do you have a sense of where the job cuts are coming from?
Well, one thing we do know from the Wall Street Journal's reporting is they're going to be scrapping their metaverse division. It's interesting, of course, given that Meta itself rebranded from Facebook. It has not really talked about the metaverse at all in either of its two most recent earnings calls, and it has also been cutting a lot of jobs. It was a hot buzzword a year ago. Now the conversation has moved away from that and Web3 and similar topics more towards AI.
All right, Alex, thank you so much. Mandeep, from your vantage point, as you start talking about Meta, what are we seeing in terms of the social media tech giants and why those layoffs just keep coming?
I mean, from my perspective, there's something idiosyncratic about Meta simply because they've laid off almost, 25% of their workforce. And, they're still doing these bonus cuts. To me, it suggests that not only do they see top line slow down, at least for the next 2-3 years, there is question marks around the terminal value of this business simply because you don't know what the structural impact of Apple's changes or, the engagement loss that they have had to go through. And the metaverse bet that Alex alluded to, look, they're still losing $10 billion plus a year. And even after these layoffs, they continue to spend. So there is definitely a bigger risk for investors in terms of the future of the company. And that's why you see them, pull these levers on the cost side.
How much, Mandeep, are you seeing a justification for just how much the shares of Meta have rallied on cost cuts, given some of these questions around terminal value?
Yeah, so look, I mean, Meta is still a 80% gross margin business. The question is, will it remain to be 80% gross margin? If you look at Microsoft and Alphabet, they're more mid-60s now. And, for a Meta to continue to grow revenue at 80% gross margin without diversifying its revenue base, it's almost unlikely at this point of time. So you're going to see gross margin degradation, and now they're trying to offset it with cost cuts, which is what investors are happy about.
Alex and Mandeep, thank you both so much. Another tech stock we're watching this morning, Alibaba, surging. China's e-commerce giant jumping the most since January after announcing its plan to split its business into 6 units. Bloomberg's Tom McKenzie joining us now. Tom, what was the rationale behind the split?
Lisa, this is the biggest restructuring for Alibaba since its founding in 1999. The rationale, two fronts, really, and you would assume that the government, the Communist Party, has given this move their blessing. For the government, this ticks two boxes. One, it addresses their concerns about the monopolistic behavior of Alibaba as they view it. Number two, it makes a play at trying to convince private enterprise, private business in China that the Communist Party has got their back now and that they support that. Because what you're going to see, these 6 units spun out of Alibaba around logistics, around e-commerce, around cloud, around media and entertainment. They will then be able to go and raise their own funds. And the CEO of the overriding group has made it clear, Daniel Zhang, that they can also look to IPOs. So that is what is being suggested and what is going to happen as a result of this restructuring. The other question is, to what extent is this a template for some of the other big tech giants out there in China?
And that's a big question right now, Tom, especially as you start to see an increasing consolidation in Beijing. And meanwhile, for some of the sector price action this morning, let's get to Bloomberg's Katie Greifield. Katie, what's going on out there?
Well, it's a quiet day overall. If you look at the S&P 500, down about 0.2%. If you look under the hood, it's a little bit more interesting. Right now, you have 7 sectors in the green. Industrials leading the way. They're up about 0.5%. Consumer staples, too, seeing a bit, as is materials. So looks a little bit defensive to me. Then you look at the downside. You have communication services leading the way lower, as is big tech. Remember, these had been the outperformers. Not so much this week. Both of those sectors down for a second straight day.
Thank you so much, Katie. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. As you can tell, we are seeing sort of a range-bound market trying to find some direction, although the NASDAQ continuing its underperformance after yesterday's as well. Suddenly a reversal of the trend we've seen this year. This is Bloomberg's The Open. I'm Lisa Abramowicz in for Jonathan Farrow. Taking a look at markets, the theme this week perhaps is the underperformance of the Nasdaq, down 0.6% versus just a 0.1% decline on the S&P. This really driven by this feeling that perhaps we could see some increase in rates, perhaps beyond what people thought, or at least keep them higher for longer. You're seeing the two-year yield above 4% after being as low as 3.5% not that long ago. The 10-year yields at 3.5% currently. A bit of dollar weakness as people readjust to where we are post some of the banking stresses. Time now for the trading diary you need to be watching this week. 2 days of bank hearings on Capitol Hill kicking off at the top of the hour. President Biden discussing his economic agenda at 2:30 Eastern. U.S. GDP, another round of jobless claims, all coming on Thursday. Plus, of course, Fed speak coming from Kashkari, Barkin, and Collins, followed by Williams, Waller, and Cook on Friday, and closing out the week with the University of Michigan sentiment survey, as well as core PCE, that key inflation metric that the Federal Reserve typically does look at. Right now, those hearings are beginning in Washington, D.C., as people get seated and prepare to do an autopsy of what happened on March 8th and in the weeks after. This was Countdown to the Open. This is Bloomberg.